How is fair market value calculated for gift tax? Imagine you're giving a gift to a friend or family member. How do you figure out what it's really worth? That's where fair market value comes in. It's the key number used to determine gift tax. But how is it actually calculated? Let's break it down. Fair market value is the price at which the property would change hands between a willing buyer and a willing seller. Neither is under pressure to buy or sell, and both know all the relevant facts. This means the value reflects what the property is worth in a normal, open market. For cash or stocks that are traded publicly, it's simple. You look up the current market price on the day you make the gift. If you give away shares of stock, the value is the closing price on that date. When it comes to real estate or personal property like jewelry or art, it's a bit more involved. Usually, an appraiser will evaluate the property. They compare it to similar properties that have recently sold in the area. They also consider the condition of the property and current market trends. For example, if you gift a house, an appraiser looks at recent sales of similar homes nearby, adjusting for size, condition, and location. Valuing interests in a closely held business or non-public assets is trickier. You need a professional appraiser to do a detailed valuation. They might use methods like discounted cash flow analysis, which estimates future earnings, or compare the business to similar companies. They also consider the assets owned by the business. The IRS wants these valuations to be thorough, well documented, and based on accepted methods. The date of the gift is very important. The fair market value is always determined as of that exact day. If you're unsure about the value, hiring a qualified appraiser is the safest move. They provide a report that supports the valuation if the IRS ever questions it. This is especially important for complex assets or large gifts. In estate planning, getting the fair market value right is essential. It affects how much gift tax you owe and how much of your lifetime exemption you've used. For example, if you gift real estate worth $100,000, that amount is what you report for gift tax purposes. If the recipient later sells the property, their basis for calculating capital gains tax is also based on that value. To sum up, fair market value is the market-based price of the property at the time of the gift. It's determined through market prices, appraisals, or accepted valuation methods depending on the type of property. Making sure this value is accurate helps you stay compliant with tax laws and plan your estate wisely.